Yeah, good afternoon, and thanks for taking the time. Welcome to this update with SKAGEN Focus. It's me and David Harris presenting here today. We have named this presentation Staying the Course because that's exactly what we think we have been doing over this year and the other years as well, of course, applying our contrarian value investment style despite these apparent obstacles out there. There's been general headwinds for value investing, as you all know. But despite this, we have, as of late, we think, delivered very strong performance. We have, over the last 6 months from the March lows, really exceeded the global underlying equity market as well as any value index. So we're very happy about that. The fund actually did an all-time high in Norwegian kronas in September, which we'll talk more about, and the drivers behind this in this presentation. We'll also take a look at portfolio positioning and new investment cases. So just briefly, very briefly, you all know this by now, most probably, in terms of what SKAGEN Focus is trying to achieve. We are a highly concentrated global equity fund, 40 to 50% in the top 10 positions. We're currently at 48%, a very healthy concentration level there in the fund. We have an unconstrained mandate. This open mandate we have now used to invest no less than 75% of our funds into small and mid-cap positions, mid-cap positions being lower than $10 billion US dollars in market cap size. The simple reason behind that is that we find much better value in the small and mid-cap space currently, almost in any geography, compared to these mega terracaps currently developing strongly in the US indices primarily. As you know, we are absolutely focused on generating returns and applies a valuation framework, which is also on an absolute level. We need to see a 50% upside in 2 to 3 years in any position, and also using fundamental exposure factors which also is an absolute risk management framework to support our work and portfolio construction in the fund. So the key client points here for the last year is basically, it's been a year of two halves, basically. We've seen the huge correction, of course, heading into the February-March timeframe, where the market tried to discount the dynamics surrounding the pandemic, and also excessively so, we thought, in many of our own investment cases. We managed to re-engage or buy more, basically, of some of our favorite stocks in that correction, and that have resulted in a very good performance over the last 6 months. We re-engaged, for instance, with West Fraser, our lumber producer, Hornbach Holding, and a number of commodity names, for instance, in precious metals, which really delivered over the next 6 months. As such, we did essentially decouple from these value indices, interestingly, over the last few months, and also put in a new all-time high in the net asset value of the fund. 2 positions hitting price target, Hornbach Holding and our do-it-yourself retailer, and Fortuna Silver. We bought Fortuna Silver just in excess of 1 year ago, delivered a 200% return here over that period. So a very strong development for Fortuna Silver. Very importantly, we have still a very interesting and attractive upside in the fund, despite this recent rally in the NAV. It's almost 60% to our weighted price targets across the portfolio. The value indices hasn't done much. So we think the massive rotation potential from these growthier, specifically the US-centric FANG complex names, persist going into these value assets where SKAGEN Focus is exclusively a position, of course. So it's not about the S&P 500 anymore. It's about the S&P 5. This is a simplistic description, but these days you have these 5 companies. Actually, last time I looked, it was about 25% of the actual underlying S&P 500 weighting, of the total market cap in the US. And this is a new record high for that type of concentration risk, if you will. In the last time it was close was in year 2000. You had an 18% weighting in 5 names. That was in the tech bubble, of course. And we all know what happened when that type of concentration levels appeared. So we can historically conclude, our observation is that these concentration levels are associated with a very poor risk reward going long these concentration risks historically. We can also see that the average US company hasn't done that well. If you're willing to exclude these 5 companies, you have actually an S&P 500 where it's up around 9% is the actual index. The FANGs or the 5 top stocks is up like 54%. But the average remaining 495 companies is flat or actually almost down for the year as we speak. So these companies have really masked a totally different picture underneath in the S&P 500. Of course, this is what you get if you are buying an index fund or a global technology fund for that matter. You're getting these concentrations risks, and that is worth taking into account. That's why we recommend a balanced approach between value-based investment management and perhaps these type of investments. So just another way of looking at this, we have plotted the Apple market cap versus the FTSE 100, which is the entire UK equity market, as a matter of fact. You can now see that these two are on par. So the complete UK equity market is now trading at the same market valuation as Apple, this single one company in the US producing cell phones. We know it's an excellent business with very high margins, high barriers to entry and so on with App Store. But still, this is an intriguing and an absurdity, I think, in today's equity markets. You have these interesting comparisons. This is, of course, driven by the extreme global tech equity fund inflows we've seen over the last, excessively so in 2020 in this recovery. We all know that the retail trader is back with these options and so on, and these trading platforms, Robinhood and so on, where you trade basically without any commission whatsoever. And this is obviously inflating these numbers in these stocks that apparently cannot go down, it seems. At least at this current time. So we're seeing a very, very, very strange environment out there, we think. So the tale of two halves, what is the meaning? Well, you see the actual point we're bringing up here is that we, heading into the correction, of course, fell more than the average equity market in the correction. We thought it was an excess correction in many of our equity holdings. In this increased volatility, we managed to pick up many of our favorite names in that correction. Of course, then what happened was the huge rally we've seen in the fund in the blue line here, up 43% since the March lows in euros, versus a equity benchmark of 20%, and the value indices not doing much at all actually. So I think our achievement with carrying a portfolio which is much cheaper than these value indices and still outperforming and this magnitude, I think, is an achievement. And on the year, of course, we are way ahead of the value indices, the green chart here, and also catching up strongly with the underlying equity benchmarks. You're seeing here from another angle, just the performance chart, and really we started to decouple from these value indices somewhere in May. It's been driven by a number of positions, as we will see. It's been primarily Rocks Gold, Ivanhoe Mines, been very strong for us in precious metals. One reason behind the very weak development for value is the financial weighting, which is the financials are a very large part of the value indices, and financials has been a very poor part of the equity market for 2020 and also for 2019. Banks, insurance companies not doing well when interest rates are so low. Now we also have the credit quality dynamics with banks. So that's one interesting observation here, I think. So this is the all-time high notation in the NAV for September. This is in Norwegian kronas. So you'll see here the very strong recovery we've seen in the NAV over the last 6 months.
All right, looking at the performance since the bottom of March, it has to a large extent been driven by our 5 biggest positions in the fund. And we have witnessed a so-called revenge of the miners, and the portfolio represented by companies such as Roxgold, Ivanhoe, and Oz Minerals. And you see the Star Wars inspired picture here actually used by the management of Ivanhoe in a bullish presentation earlier this summer. Miners has really benefited from rising commodity prices, driven to a large extent by the weaker dollar, demand for inflation protection, and the low interest rate environment. Our exposure here is ultimately quite diversified. So we have exposure to precious metals through gold, Roxgold, our largest position in the fund. But then we also have exposure to industrial metals, primarily copper, through Ivanhoe and Oz Minerals, which gives us quite a balanced portfolio in this aspect. Also, just want to highlight a very strong contributor, West Fraser Timber, our North American lumber producer, which has benefited from soaring lumber prices in the other half of the year here, on the back of increased demand in combination with supply shortages. And also the wildfires that has spread now through the US has contributed to a sustained price momentum, which is very high, seasonally speaking, benefiting companies like West Fraser. The fund continues to have a very high exposure towards Japan, and in the recent months, Japan's Prime Minister Abe announced that he will step down for medical reasons. This has worried some investors, as he has been the longest sitting post-war prime minister in Japan and is known for many of the reforms he has initiated. To our understanding, we believe that his successor, Prime Minister Suga, will offer very little change in terms of political direction. We believe that the corporate governance momentum that has been going over the last year will be sustained. It's unlikely to unravel, but most importantly, we think it's as highlighted on the chart here, Japan has never been this under-owned by foreign investors, which we think reduces the risk for any potential outflows from the region. And we think it's also interesting to know that Warren Buffett, which is known to many as a value investor, has diversified and taking a large position into 5 Japanese companies. So the fund continues to carry a high exposure towards Japan, in excess of 20% of the fund. SKAGEN Focus has always had a tilt towards small and mid caps, but it has risen over the last years and is actually now at 75% of the fund. And as Jonas alluded to before, this has much to do with valuation. We tend to find much more attractive valuations in this part of the market. We also find much more clean and pure local exposures. And this part of the market also tend to be much more under-researched, which we can benefit from with our global and unconstrained mandate, where we can move swiftly across sectors and regions. So you can expect that to continue going forward.
Yes, looking at our value spectrum here, you've seen this slide before. I think we have these boxes of value, different types of value, if you will, that we try to diversify between. And we have a number of new positions here listed in these boxes. So you can see, for instance, we have Konecranes in the mean reversion value space. Konecranes is essentially a producer of workstation cranes, industrial cranes. It's a Finnish small cap name, which we have initiated over the last month or so. This is a company which has a growing service component, which we think is highly underappreciated by the markets. They have some activities within the ship and portyard crane business, which is obviously doing now running a very low capacity or have a depressed run rate of earnings. And we think a normalized level of earnings power in Konecranes really would mean an in excess of 50% upside in 2 to 3 years for this particular company. We also invested into Wienerberger, which is the world's largest producer of bricks. Bricks being used more in terms of the environmental and also the sustainability issues around housing. We think Wienerberger is highly underappreciated, since the market values it like a commoditized player, while in reality it has a very interesting dynamics with the infrastructure part of the business, which is about 30% these days. They're manufacturing pavements and pipes. So much less cyclical than before, with a much higher residential housing exposure like 10 years ago. got a very good balance sheet, and also is an M&A accumulator in terms of these local brick factories. Wienerberger is buying at very interesting valuation levels and sort of increases its footprint on a global basis. Lotte Fine Chemical is a new position in South Korea, which is also a small cap in Korea, trading at very interesting valuation dynamics at 4 times earnings, EV/EBITDA, or 3 times at a net cash position, bringing the EV down to absurd levels, we think. It's also valued like a commoditized player, although they have segments that are growing very nicely and supplying, for instance, the chemicals for the texture into vegetable foods, for instance, which is a business that they really should spin out or something just to increase the valuation of this stock. Also, lastly, FFP is the Peugeot family investment company in France. This is a small cap name in that local market. FFP is an investment company holding a diversified basket of holdings specifically in France. We think this company assets are conservatively valued at 150 euros per share. The stock is currently trading at about 70 euros. And why do we say it's a discount on discount value situation? That's because they own Peugeot. Peugeot, they have a 30% ownership stake in Peugeot, and we think Peugeot in itself is undervalued, currently undergoing a merger with Fiat, where you're going to have synergies, and that being a very interesting investment position as well. I want to highlight these are all small and mid-cap positions, which we initiated over the last 3 or 4 months here. So what about the value investing in general? What are the prospects for an outperformance of the value segment and SKAGEN Focus going forward? Well, it's interesting. We have actually decoupled from these value indices. So we think we have the best in front of us in terms of the potential for a sustained rotation into value assets. We think clients should at least apply on a balanced style approach at this part of the cycle. We have this massive monetary and fiscal stimulus, of course, providing a very interesting tailwind for the cyclical part of the value complex. We have a record gap. The starting point is extreme. Concentration risk is at record high in the other parts of the market, as we have shown you in this presentation. The cyclical components of value will show a very interesting growth rate, I think 21 and 22, heading into 23 in the midterm, in the 3-year perspective, which we operate in. This will also be, I think, affected by the vaccine developments for COVID-19. It will come, nobody knows when, but it will surely be a headwind for some parts of the cyclical market. For instance, the travel leisure market, the airlines and so on. This is an area which really is quite interesting at the moment. It might be too early to engage here, but you have these areas of the market which really can come back strongly, we think, with a vaccine in place. So we think there are very good prospects for value investing over the next 2 to 3 years. This is just showing our work around the global Nifty-Fifty and the Thrifty-Fifty. The Nifty-Fifty being the 50 most expensive stocks in the MSCI all-country world. The global Thrifty-Fifty being the cheapest companies in that same index. And you can see here, there's been nothing done to close the gap here in the latest rally in equity markets. And of course, this is driven mainly by these mega terra caps in the top positions of the Nifty-Fifty. And Thrifty-Fifty being, of course, a good weighting in financials. So this is interesting, but we think that this potential for a gap closing here is or at least a reduction of the gap is really interesting in the midterm.
Right, now just looking at some of the positions that has been closed and has left the fund. I think many of us have spent a lot of more time at home during the pandemic, and this can lead to a lot of things, creativity, but also the need for or desire for refurbishment, which has benefited Hornbach Holdings, which has been a position in the fund since 2018. This is a do-it-yourself operator, among the biggest ones in Europe. The investment case was built upon an attractive outlook following a heavy investment cycle that the company made and could really capitalize on now in this environment when it comes to the online format and e-commerce. And so this has been a very good run for the fund, and we have closed that position. The company actually raised guidance twice this summer. So it's a very strong run. We also closed our position in Fortuna silver mines, which can now capitalize on their contrarian move in the cycle to invest in the Lindero asset, which is soon coming on stream, which eventually will make this junior silver mining company to a much more bigger and diversified mid-tier producer. It will also diversify its revenue mix, which the company has benefited from. It will go from being a more of a pure silver exposure towards a balanced exposure towards silver and gold. Gold, as we mentioned before, is trading at record high, and silver, which has historically been correlated with gold, has been substantially lagging and been catching up during the summer. So the company has benefited from that, and surely the stock, as you can see, up more than 200% during our holding period. So it's very strong. We mentioned what we did with much of the capital reinvested in our new positions that Jonas mentioned. Also increased our position in SAF-Holland, and the European truck component supplier, and also the pulp producer UPM. We closed our position in Hornbach Holding and Fortuna Silver, as I mentioned, and also closed our position in Continental and Hyundai Motors to fund some of the new positions, and as we see much better risk reward there. We also decided to trim and take home some profit from our positions in Oz Minerals and West Fraser Timber. Looking at the largest contributors year to date, we have touched upon the most. Can also mention Kroger, the US food retailer, which had a very strong run in the beginning of the year. And then looking at some of the detractors, we have our position in Austrian integrated energy producer OMV, which suffers in this environment due to lower energy prices and also lower demand for energy. We have our US insurer Lincoln National, where investment income is hurt due to the lower interest rate environment and to some extent high credit spreads. We closed our position in UniCredit despite a successful restructuring, but we struggle to see catalyst in this type of environment for the stock. So we closed our position there.
Yeah, looking at the top 10 positions, just briefly, 35 positions we mentioned, 75% now being, or the total portfolio being small and mid-cap space. We have a healthy concentration level, about 48% in the top 10. As you can see, we have 4 of these companies in Japan, Hitachi being the largest one, which essentially is a very undervalued industrial conglomerate, being a leader in governance and currently undergoing a restructuring of its operations, simplifying its business prospects. We think that's going to involve Hitachi Construction, which you see is the 10th largest holding. We think there's a highly likelihood that they will either sell or buy in Hitachi Construction equipment, that being a very cheap and undervalued name in itself. But we have these 2 horses, if you will, which are really a core position for us. 2 South Korean financial companies trading at insanely cheap levels we're talking about an ROE of 8 to 9% in these companies, trading at 40 or 30 times book value, which is extremely cheap, even for South Korea, to put it plainly. The valuation of the actual portfolio is cheap. It has run up a little bit with the recent NAV increase here, 1.3 times price book, 11-time price earnings, with a healthy return on equity across the portfolio at around 8%. Also, importantly, again, 60% upside to our weighted price target. So there's still plenty of upside in 2 to 3 years. And we're working with a pretty fresh portfolio as well, in terms of many new positions entering and sort of going higher in weight here as we speak.
Right, I'll be brief here in the interest of time, but we just want to highlight one of the positions in the fund. We had quite some activity during the summer here. Fujitec is a Japanese elevator company. And I'm also happy to introduce Techie. As you can see on the right side is the company's mascot. It's primarily his mission is to teach children to ride in elevators and escalators in the right way, but we think he can also be helpful here in illustrating the investment case. So what is Fujitec? Fujitec is an escalator company. It has a global presence. It's the 8th largest elevator company looking at comparing globally. 90% of sales are derived from Asia, primarily Japan, but they also have quite a lot of exposure to China, which we think is attractive. This is a very attractive industry where profitability from aftermarket sales, service, maintenance and repair is very high, as there are quite high barriers to enter this industry. So the setting is very, very attractive. But looking at Fujitec, despite this attractive business model and their long history, it trades at a very low multiple, especially compared to peers, and it has done so for quite some time. And why is that? Much of this is attributed to the company's operating inefficiencies. It's very poor capital allocation and very weak governance structure. The company owns 10% of itself. It has been building a substantial cash position over the years, which is priced as if it's not there or at all, essentially. We have been looking at this company for quite some time. As you can see, there are several low-hanging fruits that the company could do something about, but they haven't done so, and we have struggled to see possibilities for change until recently. So what has changed? Well, there has been a lot of change within the holding ownership side of the company. We have seen a lot of new investors entering the name, and these investors has turned very vocal, demanding change from the company. And as their position has increased and become substantial, this also started to impact the company as they demanded a more rational capital allocation, increased board independence, and independent review that could lead to a margin expansion in line with other peers. And a very positive thing here is that the company has responded positively and admitted that there is need for change and that they will do something about this. So we think that there are several catalysts ahead. This is a 3% position in SKAGEN Focus and has performed very well over the summer. We also want to highlight that it was that the company and the investment case was mentioned in the Wall Street Journal. And we think that's quite amazing, as it's rare for a Japanese small cap company to be mentioned there. So very attractive case going forward, 3% of SKAGEN Focus.
Just to sum up, strong fund performance, and essentially decoupling from these value indices, which we're quite happy about since March lows. So brisk idea generation in FFP, Fujitec, Konecranes, Lotte Fine Chemical and Wienerberger, these exclusively being small and mid-cap names, 75% of the total portfolio in these small and mid-cap positions. Two companies hitting price target with Fortuna Silver and Hornbach leaving the portfolio. Still very strong upside across the portfolio at actually 60% now, which is a decent upside for 2 to 3 years investment horizon across the entire portfolio. And importantly, we think that the rotation potential persists, since these value indices hasn't done much in this recovery, and the gap between cheap and expensive, if you will, has just increased further. Thank you.